If you're planning to sell your business at any time in the future, this could be the most profitable video you watch all year. There's a section of the tax code, section 1202, that lets you legally pay zero in tax when you sell your business. But here's the catch. Most business owners either don't know it exists or they hear about it too late to use it. In this video, I'm going to show you exactly how it works, how to qualify, and how the right structure today could save you millions when you exit your business. Stick with me because by the end, you'll know how to turn a $10 million exit into a $10 million windfall. To take advantage of this tax exemption, you must meet these key criteria. Section 1202 is part of the Internal Revenue Code that allows for up to 100% exclusion of capital gains when you sell what's called qualified small business stock, or QSBS. In plain English, if your company qualifies and you structure it right, you could sell for millions and not owe a single dollar in federal capital gains tax. Let me say that again. Sell your business, pay no tax. Number one, the company must be a C corporation. S corporations or LLCs taxed as S corporations or partnerships do not qualify directly. So you do not want to convert your S corporation to a C corporation. That will not work. However, if instead you drop all of your assets down into a C corporation owned by the S corporation, that will work. So just because it says that only C corporations qualify and you can't convert an S corporation to a C corporation, that doesn't mean you can't still take advantage of 1202. Number two, stock must be original issue. In other words, you must have acquired the stock directly from the company. You cannot be getting it buying it from somebody else. So let's take our situation again. Okay, so we have this S corporation. It's operating. Well, if we contribute the business assets to a new C corporation in exchange for the stock of that C corporation, guess what? That is original issue stock. Now, in that case, only the appreciation from the time you make this change, from the time you form the C corporation, only the appreciation from then until you sell it is going to be tax-free. So the sooner you do this, the better off you are. Number three, it must be a qualified small business. What does that mean? It means that the assets, when you form the C corporation, have to be $50 million or less. So if your S corporation is worth more than $50 million, we can only drop $50 million or less of assets into the C corporation. But remember, it's how can we do it, right? It's not can we do it, it's how can we do it. So let's say we have $70 million of assets in our S corporation. Well, let's drop $50 million. Let's keep $20 million out. And so we qualify as a qualified small business. So it's just $50 million or less at the time we receive the stock. And it has to be an active business in a qualified trade. It cannot be a professional services business. Okay, professional services business, like my business, accounting, they don't qualify. Now, how long do you have to hold the business? 5 years. So if you're planning to sell the business in 3 years, you're not going to be able to take advantage of this. However, just because you sell in 3 years doesn't mean that you don't still get the benefit, because if you sell your business in 3 years and you invest the money into a new qualified business, and then you sell that stock more than 2 years later, guess what? You've hit your 5 years. So the reason I bring up these technicalities is because people tell me, well, you know, my accountant said I can't do that. Well, the question is never, can I do it? The question is, how can I do it? How can I do what I want to do, which is sell my business, pay the least amount of tax possible? The challenge is that if you're coming to me right as you're about to sell, I can't do anything for you, right? Say, hey, Tom, you know, I'm about to sell my business, or even worse, hey, I sold my business 3 months ago. Can I do something about the gain? Okay, well, we could do a opportunity zone. Okay, there are actually things we can do, but boy, we can't take advantage of 1202. But I'll tell you, I have found that most businesses can take advantage of 1202. Now, when do you want to take advantage of 1202? If you're going to leave the money in the company, that's when you want to take advantage of 1202, because remember, it has to be a C corporation, which means that a C corporation, of course, has a double taxation, right? They pay a 21% tax on the income when it's earned, but then there's another tax on the dividends. So if this is a company where you pull all the money out, 1202 is probably not the right choice for you. However, if there's even a part of the business where you're going to leave the money in and grow the business, and if your goal is to really grow this business, 1202 is an opportunity you can't afford to pass up. Now, how much can you exclude? Well, interesting, there's a $10 million gain limitation. $10 million on whom? So it's $10 million per shareholder. So could you have multiple shareholders? Well, yes. Now, you and your spouse, you're not multiple shareholders. However, you and a trust, you and your children, you and your other partners, all shareholders. So everybody gets the $10 million. So we can multiply that $10 million. And so don't think that it's just 10 million. So you plan to sell your business for 50 million. Could we get a $50 million exclusion? I guarantee you, if you're willing to do the work that it takes to get 5 different owners in there, we can do that. Now, here's how high income entrepreneurs and investors can minimize the 1202 benefit. First, start a C corporation early, or drop your assets down from your S corporation or your partnership into a C corporation. Do it as soon as possible. Multiple shareholders, each shareholder gets the $10 million exclusion. And you can use trusts and family members. We call this stacking and packing. You can use trusts and family members to multiply the exclusion. And your exit timing is important because it's 5 years from the time that you first get your stock. Now, I've had clients where they sold their company or some of their company. Let's say they had a new investor come in and they sold some of their stock to that new investor, say after 3 years. Okay, well, that stock didn't qualify because it's only 3 years. But then 3 years later, they sold some more stock to new investors. Well, guess what? 3 years later, now we're at 6 years. Now we qualify. So just because that first investor doesn't qualify doesn't mean the next investor might not qualify. Now, a couple of things to watch out for. Remember, professional service industries, law, accounting, finance don't qualify. Second of all, healthcare, by the way, also. It has to be stock. You can't sell debt, and it can't be an S corporation stock, can't be a partnership, has to be C corporation stock, cannot be the assets of the company. Now, there are a lot of buyers that don't want to buy the stock. There are ways to deal with this. There's ways to deal with that depending on what the buyer insists on. Okay. So be sure to bring in a good tax planner, a really good tax planner, both an accountant and an attorney to work through this with any buyer because it does have to be stock. And remember, state taxes could be different. So you could still end up paying state tax. Of course, there are other ways to avoid state tax on the sale of your business. Now, remember, number one, your business must be a C corporation. If you're a partnership, LLC tax is a partnership or an S corporation, then you'll need to restructure. But don't worry, we got that covered. Number two, you must buy the stock directly from the company. It has to be original issue stock. You can't buy it from somebody else. Now, if it's a gift from somebody else and it was original issue stock to them, it will still qualify. Okay. Number three, your company's assets have to be under $50 million, okay, at the time the stock is issued. After that, it can go up to $300 million. Doesn't matter. It's at the time the stock is issued. Basically, that's the government's way of saying we're incentivizing small businesses. We're not incentivizing big businesses. And number four, remember, you have to hold the stock for 5 years. Here's a bonus. Your business has to be in a qualified industry. That includes most product-based companies, like online retailers, tech startups, manufacturers. Certain service-based businesses like law, finance, accounting, and healthcare don't, but there are some that might, okay? So you might think I'm in the healthcare business and you may actually be in the retail business, like a pharmacist. So a pharmacist may qualify even though you think of a pharmacist being in the healthcare business, when in fact, the way their business is set up and may not be healthcare under the law. So make sure you follow every little word of the law. Every word counts when it comes to the law. Most business owners lose millions in taxes when they sell, simply because they don't know about Section 1202. The tax-free exit blueprint shows you exactly how the wealthiest founders pay zero, legally pay zero in federal capital gains tax when they exit. Inside, you'll discover the 4 must-have criteria to qualify for a 100% tax exclusion. How to structure your business now to cash out tax-free later, the strategy smart founders use to multiply the exclusion for partners, spouses, and family trusts, and how to turn a $10 million sale into a $10 million windfall completely tax-free. If you plan to sell in the next 3 to 7 years, this is required reading. If it's even longer than that, you still want to start now, because the sooner you start, the bigger your exclusion is. The best time to plan your exit was 5 years ago. The second best time, right now. You can download the PDF below. Now, here's the fun part. How much can you actually exclude? Under Section 1202, you can exclude the greater of $10 million or 10 times your original investment basis. I rarely see the 10 times come into play, because normally people have invested less than $1 million. Right? $10 million is usually bigger. So if you started your company with $500,000, sell it for $6 million, that's actually $5.5 million in tax-free gain. Now, it might have been you put $500,000 in, and you put it into an S corporation, you got your deduction for that $500,000 because it was all in costs. So now your basis is zero. You now form the C corporation. So see, when we talk about different entities, we always want to talk about how to use all of the entities together. Don't think that just because it's 1202, oh, we've got to do a C corporation. Yes, we do. But that doesn't mean that we don't also use an S corporation or an LLC tax as a partnership. Those are options that we always need to take into account when we're looking at your specific situation. What if you invested $1 million and sell it for $12 million? You can exclude up to $10 million of that. And if you invested $2 million and sell for $20 million, you could actually exclude up to $20 million, 10 times your basis. So it really is that every once in a while, I see that 10 times apply. So don't forget it. It's both. It's the greater of $10 million or 10 times your basis. Now, of course, if I was investing less than $2 million and I sold for $20 million, I'd really just multiply my exclusions, right? So that we can actually take advantage of the whole 20 million. Each shareholder, remember, gets their own limit. So if you planned ahead with family trusts or partners, you can multiply the exclusion. Section 1202 is one of the biggest tax savings opportunities any entrepreneur has. Your single biggest asset is probably your business. It's not your home. For employees, it's their home. For you, it's your business. And you probably don't have a lot of basis. That's your tax cost. That's how much you paid for your business minus whatever losses you took in the early years. You probably don't have enough basis. And so you're probably going to have huge capital gains. Most entrepreneurs have capital gains almost equal to their selling price. They have very little basis in this. So if you can imagine $10 million and multiple of $10 million being tax-free, that is the name of the game. Even at a 20% capital gains rate, that's $2 million of tax savings for every $10 million of gain that you're not recognizing. But remember, it takes planning. You don't just wake up one day and sell tax-free. You have to set your business up correctly, ideally 5 years before the sale. And if you're not a C Corp yet, now is the time to evaluate whether you need to set up a C Corporation. Remember, we're not converting an S Corporation to a C Corporation. We're actually forming a new subsidiary of the S Corporation, putting the business assets in so that we can take advantage of Section 1202. So if you're building a business that you plan to sell, you already own stock in a startup, don't leave millions in taxes on the table. With the right structure, the right timeline, and the right guidance, you can exit your business and legally pay zero in capital gains taxes. This is not something to figure out after the sale or right before the sale. The best time to set this up was 5 years ago. The second best time is today. At Wealthability, we specialize in helping business owners like you design tax strategies to make exits like this possible. We don't just prepare taxes. We help you build permanent generational wealth. Schedule a strategy call today at wealthability.com and let's map out your path to a tax-free exit.